Good evening, everyone. It's a pleasure to have you all once again today on this 10th session of the series of fundamental and technical analysis conducted by us at Sampath SC Securities. And I'm Saliya. Today, we are moving into another interesting area as far as technical analysis is concerned, where we will be discussing or looking at chart patterns and how we can make use of them to make profits in our investing and trading journey. When it comes to the charts, one of the easiest ways to understand about these chart patterns is if you are familiar with stargazing. Somewhere down the line in our lives, we would have been experiencing this scenario where we used to sit at a dark night, looking up at the sky, and then seeing many stars in a clear sky. And if we have that knowledge of drawing shapes by using those stars, it would have been an interesting encounter in a scenario like that. In the case of charts also, right, we have something similar to that. All these price actions that we can see here, if you're familiar with the chart patterns, by just by the looks of or at a glance, you will understand or you will come to know the patterns that are appearing in the charts. At the same time, that once improved, will be very easy for you to identify those patterns or building up of those patterns in the present situation as well. Therefore, it's very important to for individuals who used to or who have constituted a liking towards following charts and making use of the chart behavior, price behavior, and the volume behavior to your advantage. And if you believe that you can make make use of this behavior of the charts for you to make profitable trades, and that is the most important thing that we need to train ourselves in doing. Because we have come across a lot of individuals who don't even put a red cent into the market, but they describe the chart behaviors, right? That's kind of a futile effort, because you're putting your time, energy, and using your valuable data, and also you are wasting a lot of time in learning this art. But still, if you're not making use of it, that's an unfortunate scenario. Therefore, I believe that if you get the hang of these sessions that we are covering, you will definitely reward. And at the same time, I know very clearly that many of you all have started practicing this, trying to learn a little bit more about it. And as time goes on, I'm sure these lessons will definitely help you to include into your own investing and trading styles. When it comes to, as I mentioned, you have many types of patterns that you can see, and we'll be going through those patterns in a chart. And this is something that had been developed. All these patterns, according to my understanding, had been developed before the technology came into the capital markets in the world, right? Before any of these software platforms that use data in order to make decisions in terms of investing and trading came into the picture, almost all of these patterns were created by many technicians, and it dates back to the early 1900s as well. The understanding that I have is that in the 1930s, there were chartists who have introduced the patterns. So, we are fortunate now because we have all the data available, in a matter of just keying certain keys, and we can, load a chart and start using the charts the way we want. So what it means is that it's the commitment, the interest that you have to, understand and increase knowledge in terms of all these, subject areas, which are certainly very, very powerful tools for you all to make use of when you are using to your advantage. So first of all, for just like for any tool or indicator that we showed, there are systems in place, procedures in place when we are developing these patterns. And as a result of that, when it comes to chart patterns, we categorize them into two segments. One is called the trend continuation patterns, and the other is called the trend reversal patterns. Trend continuation patterns and trend reversal patterns. And when we are developing those patterns, we not only use the candlestick chart, we can use several types of charts or styles of charts that we have. Most popularly used charts for recognizing these patterns are the bar charts, the candle charts, and the line charts. That does not necessarily mean that the other charts are not beneficial. There are certain chart styles which are specifically used to identify patterns only. Those, as time goes on, we will be taking you all through them as well. But since we are more frequently using these patterns by using these three basic styles of charts, the bars, the candles, and the lines, I'm going to use those, especially the line chart and the candlestick chart, in order to spot these particular patterns. First, and the most easiest and the most important pattern that we need to understand is the channel, a common channel that we need to develop. And it is the easiest, but one of the powerful patterns that we need to master. And it won't take too much of time. As long as you know how to develop it, that's what that is what matters. When it comes to developing that chart, first of all, we need to, on our own, based on our thinking, we need to identify the trend, right? Remember, the trends can last from minutes to days to weeks to months to years, right? As such, we need to most importantly identify and believe in a long-term trend, right? We need to gather certain points personally, right? And we have to understand that we are in a long-term trend, right? That is very, very important. If we do not believe in a trend, whether it's long-term or short-term, using the charts for our analysis, and at the same time investing or trading won't really going to be beneficial to us. Yesterday, I can remember one of my friends, he was upset when Expo Lanka was at 83 rupees. Then I asked him why. He said, unfortunately, I sold Expo Lanka and bought Tokyo Cement. Then I asked him whether he believes that Expo Lanka is going to go up to 100 rupees. And he said, yes, I certainly believe it. Then I showed him that if he bought at 83 rupees and sold at 100 rupees, that's a profit of 17 rupees. Meaning it relates to a 20% return, right? So a lot of people do not understand why they use their, I mean, eternally, I used to tell that the return on investment is the most important thing in your trading or investment lifestyle. Basically, this is a lifestyle. The reason as to why I'm saying is that with the in the 30-year history, in my experience, as soon as you open a CDS account and start investing, and you want to become a frequent individual who used to look at the market, study the market, it becomes a lifestyle, right? So that's why I'm saying, if you want to turn your investment and trading into a lifestyle, then gathering knowledge, putting that into practice is the most important thing, right? I used to say that there is a word that I used to use, which is called it relates to knowledge, then practice, then you get the experience, then it becomes confidence. And I have coined it as KPEC. K stands for knowledge, KPEC. K stands for knowledge, P stands for practice, E stands for experience, C stands for confidence. If you have the knowledge, you need to practice it. When you practice it only, you will understand the pluses and minuses. The challenges that you are facing are all a part and parcel of practice. Once you practice that, then that turns into experience. Once you gain experience, then obviously your confidence has to increase. That is very important when it comes to technical analysis, right? So as I mentioned, first you need to understand the trend. You have to believe in the trend. I'm going to use the daily chart for that, but of course, you can use the weekly chart for identifying the trend. Initially, I'm going to show you, let me take you to the weekly chart itself and show you how I'm going to do that. Now, the basis for me to believe that we are in an uptrend is purely because that we were fortunate to see a trend reversal back in May 2020. That was last year, May, right? We started a new trend, and there are so many fundamental reasons and realistic examples as to why it was an important reversal and an important start of a trend. Individually you can gather information and you can have your own trend, right? As far as I am concerned, for me, I believe that the beginning of the present trend started in May. In fact, it was on the 12th of May 2020, and that is this week, and this is the bottom. I'm using this bottom to draw my main trend line in a trend channel, right? In a trend channel, you have two lines, right? A trend channel has a main trend line plus a channel line. That's why I said we have systems when we are drawing these lines, right? Or otherwise we just can, if you know how to handle, use this tool, you can just draw a line like that, okay, and do so many things that you want. But when we are drawing a certain thing, drawing patterns, there is a process, right? There are rules. We have to follow a set of points or set of rules, conditions in order to develop even the smallest pattern that we are going to show you. Incidentally, this is my this will be the first session on patterns, and we will be following to the next few weeks on patterns, and it will be very interesting to see and draw those patterns and find where and how we'll be able to make use of them for to generate profits, to generate return on investments. So I'm going to use this line, and in order to draw the main trend line, I need only 2 price points, right? Earlier on, also I have shown you how to draw trend lines by using 2 price points. In this case, when we are developing the trend channel, we will be using 2 price points, and I'm going to use the point here, the low point here, and the low point here. That's all I'm going to use. So I'm connecting that point to this point, right? And then I'm going to use the settings, go to right 10 extension, and I'm stretching it. When you stretch like that, you can see that I used only these 2 points. Earlier on also I might have mentioned this, but a trend line becomes powerful when the prices test that trend line into the future from the point that we stop the trend line, right? We stopped the trend line here and extended it. So at this point, nobody knew that the prices are going to go up, or rather the index is going to go up, come down, and retest this line, right? So the next thing is the channel line. For the channel line, what we do is we click on this line, go to clone, and then get a new line and drop it at one of these areas, right? It can be 1 point and several points, right? Minimum 1 point. Here to draw the main trend line, you need 2 points. That's the rule for the channel drawing. So I'm going to use only this point, right? By looking at this point, I'm going to take the, I'm going to take the line and drop it there, right? I'm going to take this line and drop it just on top of this, right? On top of that. Now, when I'm using this, right, the reason as to why I'm using this is because you can see that there is a rally, right, and made a high here, which is also known as a swing high, and then there is a major fall here. So to draw the main trend line, I use this, the bottom of the fall. So as such, in order to understand the channel, I used this high. So that's the basis for me to do that. And remember, this is the weekly chart, right? So we are going to take it to the other side and make a daily chart. In the daily chart, you will see that the in the daily chart, this is the level, right? So it has to come down, just touching that level, right? So you can see that going forward, this line was tested here. Then there was a breakout. That is why I always say, and we always have to expect, not that it is, or it is it is something that happens and it must happen. You know, it's not a rule as such, but we will see that many a times when there is a trend, right, it moves into a certain level, throws back and breaks out, right? It moved up here, tested that line, came down, broke and went up. When the trend started falling also, or the index started falling, you can see immediately this line got tested, went up, came back again, tested again, went up, came down, retested, then only came down to find a rest over here. So now we will see that, rather we can see that the prices are moving within the channel, right? Now that is how you look at a primary trend, right? By using the pattern called a channel, right? So that's known as a trend channel. That is the art of drawing a trend channel, right? While you are here, I mean, this channel itself will be useful if you want to, just by using this channel, you will be able to make your own trades if you want to, right? I'm not going to go to that at the moment, because my endeavor here is to show you all the patterns, you know, in the basic sense, because when we move forward, we will be looking using these channels in order to make some strategies as well, right? So this is the channel, the process of drawing the channels. Okay, let's see. There is, what is this? Tokyo next week movement up or down? Yoga Rasa is asking. Let's see what will happen to Tokyo. Before that, let's learn a little bit about what is going on as far as patterns are concerned. The next pattern that I want to show you all will be the double bottom pattern, called the double bottom. Last week also, if you remember, we were talking about double bottoms and double tops, where we call them the W top, W bottom, and the M top, right? And now in the case of the double bottoms and the double tops, right? First, I'm going to take you all through the double bottoms. We use the line chart in order to identify the double bottoms, right? Now the double bottom is, I mean, just like the name is giving you, the name implies, you have two bottoms, right? Now, this is a bottom and this is another bottom, right? So this is called a double bottom. Now, within the two bottoms, you can see that the prices have gone. So in other words, what it means is that there is a downtrend, then there is a pause, turning up into a support, then reverses up into a rally, pauses there, making a resistance, and continuing another downtrend, again pausing there and giving us another bottom, right? So that's called the double bottom. In the case of this double bottom, once you identify the two bottoms, right, then in between you have the peak here. These are also known as valleys, the peak, and you have the double bottom formation. Now, the double bottom, the typical or the classical double bottom is something like this. That's the classical double bottom, but in reality, you don't see that always. It doesn't mean that you don't see it, but you don't see it always, right? But in order for us to understand the concept, let's look at the basic or the classical double bottom, like this, right? So, as I mentioned, yes, last week also we touched on this, a W formation. Now, this is the pattern, right? But this is known as either the double bottom pattern or the W bottom pattern, right? Now, here you have one valley or a bottom, then there is a top, then a bottom, and then a rally, right? So here you have, now we are going to turn this into a candlestick chart, right? Now, in the case of the line chart, you can see that there is a clear V type pattern here, a V shape here, here also a V shape. But when it comes to the candles, you don't see that V shape here, right? Even the bar chart, if you use to identify this, you can see that it's not a clear V, right? Now, at the same time, you can see either now, okay, you have the similar formations on the candlestick chart also. Hence, we will stick only with the candlestick chart. You can see that here you have somewhat of a, I mean, if you kind of, let's take this to a shorter time period, and it will be visible to you, this level, this area. You can see that level, give me a moment. That level is not as sharp as this, you know, having a V-shaped formation here, right? So let's go back again to that, the day chart, and then you can see the bottom formation has several candles. The bottom formation has several candles, right? And when we are using the rounded bottom, and I mean, when we are looking at the rounded bottom pattern, I will show you. You know, I will draw the formation over here, but for the time being, in order to understand this W formation, we can see that there are several candles here. As against this bottom, here you don't have too many candles. You can see that the reversal has happened only with 2 candles here, right? And this candle and this candle are on top, relatively at the higher end of the 2 candles, right? Now, a formation, a W formation of this nature is called an Eve and Adam double bottom. Eve and Adam double bottom. Okay, so the the importance of an even Adam double bottom will be where now in the case of the all-share index, we don't go by the volumes, but what this formation, what it tells us is that at this area there had been somewhat of a relatively longer consolidation compared to this immediate reversal. Before the reversal took place, it had paused for a few days. Here, within 2 days, it has started moving upwards, right? So that is, at the same time, you can see that when this formation took place, the rally had been a little bit, the angle of the rally is a little bit sharper compared to the angle here, right? So when you have this Adam Eve formation, right, that gives you the indication that the support built up there is quite strong, but that has to be confirmed by the volume behavior and the breakout of the volume along with the breakout of that secondary rally or the interim rally between the two bottoms. The next thing that we look at the formation is a thing called the neckline. The neckline is here. So normally what we do is we draw a horizontal line on the neckline, right? Like this. The value here is 7666. So at 7666, we will be drawing the neckline. I'm going to show you this, and then let's take some of the other charts and see, meaning charts of stocks, and see how the double bottom has performed in those. So once this neckline is formed, or rather we know that there is a neckline here because the peak, the top of the peak or the tip of the peak is the neckline in between the two bottoms. Therefore, now we know, okay, you have something similar to this formation. You have here like this. Then you have the first leg of the W. Then you have the second leg of the W. Then you have a slanted another line, right? That's the W here. Now, the other feature that we need to understand is the projection of a W formation or a W, either whether or not it's an Eve and Adam double bottom, or Adam and Adam double bottom, Eve and Eve double bottom. Let's say you can have an Adam and Eve double bottom. You can have an Adam and Adam double bottom. Also, you can have an Eve and Eve double bottom, right? Either of these, the projection between the neckline and the bottom area is by joining the two bottoms like this and taking that using that distance we connect the top of the peak of the neckline, top of the peak of the neckline, and vertically at the bottom where that line touches the connection between the two bottoms. That is the distance of the double bottom formation. This distance is what we will be using for the projection. This is the level, right? We clone it, we take, and once the breakout takes place, this area, which is, let's take a horizontal line and drop it at the top of that level. And that's the projection of this pattern, right? Meaning this distance, once the neckline is broken, this distance can be expected for the index to rise and test as a resistance area. That is exactly where it had got tested today. You can see that has happened. So this W formation, which is an Eve and Adam double bottom formation, projected target has been hit today, right? So that's how we look at the double bottom chart pattern. That is, this is the process of developing a double bottom chart pattern. At the same time, if you just, in order to understand these W formations, right, we will be using the line chart. But once you season yourself, right, then you don't need the line chart at all. You can pick the bottoms up, or rather pick this pattern with ease, and also you can do the other processes of analysis by just using the chart, a candlestick chart itself, right? So moving further, now this was a clear double bottom formation. As such, we can see that the projection. We were fortunate to see that today, at this meeting itself, we saw that the projection had been tested. Now you have a double bottom here also. You can see that, right? But most of the time we don't use, even though you can draw a double bottom or draw a W formation here, there is a catch here, right? The catch is you have a lower low formation. This low is lower than this low. Therefore, we do not make use of it. At the same time, in order to understand whether it gives us a bullish indication, we will be using the RSI. At that point, whether the RSI is showing something opposite to what is happening here. Now you have a low here and a low here. So basically a lower low formation. Now here also we have a low and a low. It's also a lower low. During this period, at this, in this trend, right? If we saw the lows are increasing here, that is known as a bullish divergence, right? Now, if you take this low to this low and compare that with this low, these two lows, here you can see it's almost parallel, or rather going horizontally or sideways, right? But here you see that this low and this low, there is a slope compared to this movement. Therefore, there you can, even though it's not a very clear bullish divergence, the lows are showing us a different or a positive kind of a development compared to this low. because mind you, the lows have continued from this major top, which was the all-time high level of 9,025, right? So therefore, there was a change, and as a result of that, this these two bottoms, which made a double bottom formation, helped us, or it became a very strong pattern to follow, right? Now, talking of following patterns, right, we need to understand that just because you have a this pattern, just because you have two bottoms and a visible peak, which is a neckline, right, and you can clearly understand that there is a formation of a pattern, it doesn't mean that it is accurate or it is useful until the neckline is broken. If you take a conservative point of view, right, without making an aggressive decision, right, you have to wait until this neckline is broken, right, to target the target range from the neckline, right? There are instances, sometimes, frequently you will see busted or failed patterns, right? So you need to remember that. Now, other thing is, in order to make it a little bit more accurate or to kind of safeguard yourselves, right? You have the extension of the conservative approach is by looking at that throwback situation, what I mentioned in that channel formation also, right? You have a throwback, it goes up, breaks out, you wait for this throwback to happen. Here, there was a throwback, a retest taking place, either this or this, right? So when the neckline was tested on two occasions, it became a strong formation, giving us increased confidence in using this pattern, the W formation, as a useful chart pattern to expect more or less expect in realizing the target to be achieved, right? So that is what happened here. So with this, let's go to something else. The most interesting counter today is Expolanka. Let's see where those W formations were and whether it was useful for whoever mastered those techniques, whether the W formation helped them. Here also, you can see that there is a bottom here, then there is a rally, another bottom, right? Now, this is what I mentioned as a busted formation, busted pattern, right? You have a clear bottom here, then a rally giving you a peak, but another bottom here. Unfortunately, it didn't go up to break this neckline, right? So you will be waiting until the formation is taking place, right? At which point you know the area of the neckline, and then you will be initiating your buy or the entry position only after the neckline is broken and the retesting takes place, right? So that was a busted or a failed double bottom formation for Expolanka. Now here you can see that there is another drop here, then you have a bottom, goes up, then there is another bottom here, right? But again, at the neckline, it failed. It came down, it flew back up to this level, right? Thereby forming another bottom. So just because this bottom and this bottom fail doesn't mean that we cannot make use of this bottom and this bottom as a double bottom formation, right? So by using this level, let's make use of the candlesticks to find out what type of formation is that, right? So here, before this, you can even use this area. That's why I'm saying, right? You have to practice this. You need to stick to the basics, right? Identify the two bottoms, then a neckline, and that neckline has to be broken and retested, and whether after the retest, it's going to move up further, right? So here you have a neckline, you have a double bottom here, so the neckline has to be broken. Let's stretch it out. Neckline was broken here, went up, came down, but failed to hold, came back again. So in other words, what it means is that you don't see any W or rather double bottom formations in the Expo Lanka price action, right? In the Expo Lanka price action, you don't see that. That doesn't mean that the double bottom was a failure. What we do when we are looking at these double bottoms, what we do when we are looking at these patterns is to understand whether these patterns are developing. If the patterns are not developing, that doesn't mean that there are no patterns at all. There are many other types of patterns here, but this particular pattern did not form, right? Similar, therefore, we will be discontinuing that pattern, or we will be forgetting that pattern, because as we go on, you will understand that there are other types of patterns. So, within a chart, within a price territory, right, you will see various types of patterns, and we will be picking up the clear or the most, the most advantageous, beneficial pattern for us. Because the idea here is to understand, figure out the patterns so that it will give us an opportunity to make a return out of it. If we don't have an opportunity to make a return out of it, then we will not be, it's not going to really be useful for us. So that's regarding the Expo Lanka. Then let's take one of our colleagues, or rather one of my friends wanted the products, and then another wanted the Tokyo, to see whether we have double bottom formations, right? Now, without looking at anything, you can see that here there is a double bottom formation. You have three candles here, almost around the same levels, but this green candle bottom is lower than the others. Again, a classic Eve and Adam double bottom formation, right? Then the neckline will be interesting. You can make use of, because when we are using the line chart gives you only the closing prices, right? It doesn't give you the high and the low points given in the wicks of the candle, right? It takes only this value, this value. These two values are, because they are green candles, the close is higher than the open. Only these two they are taking. As such, we can take only those two values, right? And even if we do not want this low, we can take the close of the body, which is the close of that candle as our bottom, right? That tells you that you can make use of the range, the high and the low of the range, or you can take the close and the open of that candle, right? When we are analyzing the double bottom formation, right? So for this demonstration, we are going to take this as the neckline, right? This level, this the price here is 51.40. So I'm going to just draw a horizontal line at 51.40. Like that. Let's change the color to red. And you have the two bottoms here. Lighten the color and here. Okay. And then we are going to connect. If you want, we can connect these two lows, the lows of the wick, or we can connect the closing level of in the body, right? So since we took the closing of the peak, we are going to use the closing there like this. And thereafter, we will be measuring the price range at the bottom of the candle where the peak was and up to here. And this has to be the target, right? So basically here it went and met that target over here. Now what happened here was that the throwback didn't happen immediately before hitting the target. But after the throwback, you can see, or rather after hitting that target, you can see that it has thrown back and tried to come down to 51.40. Okay. So at the moment, this 51.40 is acting as a support area, right? You can see over here, it had got tested. And at the same time, eventually, again, it got, this price target got retested here, right? So basically, this is the high of 61.90, and this is another high at 60 rupees and 60 cents, right? So it went and almost tested that level. So that is for dip products. Then Tokyo Cement, if you take the non-voting first and move to that, you can see there had been a double bottom formation, but it was a failure, right? So this shows that when you have double bottom formations and there is a failure, what happens is we will be watching whether this bottom, which is a support, is going to be respected. If that support is not going to be respected, if we are making use of that support, right, we need to understand that that support is going to be turned into a resistance at a future date. Therefore, resistance is where the supply is aggressive or supply is higher. Therefore, we have to decide whether we are going to, get out of the position and re-enter again at a later date, right? So that is for Tokyo Cement. Male star will increase or decrease. Okay, with male star, I will call it a day. Let's take the male star and see whether we have W formations. Incidentally, you can see that there is a bottom valley here, right? and then there is another bottom here, and then there is a peak here. So immediately you can wait to see whether this area is going to be broken. Now this is a high, this is the close of 52.60. This level is 52.60. This level is also 52.8, right? If you move to a candle, you can see that there is a eve here, and it's a strong eve. This is a strong bottom, right? You can see that there had been a consolidation where the volumes are low, and slowly with the rally, the volumes have increased, and with the dip again the volumes have come down, and the next time around the volumes will help the rally to start. In other words, the reverse will take place, the volumes will increase. With that, this neckline has to be broken. Therefore, if we make use of these two bottoms, we can use either this or here. I'm going to use this level as the bottom here, and I'll be using this as the high, and I'm going to connect from this level to this level, and at the same time I'll be using this high, which is 53 rupees, as the neckline. And the expected breakout can take this male star to test about 59.40, right? So expected to take it to test 59.40. Once the breakout of the neckline takes place. So ideally, it has to break out, retest this 52.80 level, and then move to test this area of 59.40 or 59.50 area. So that's how you make use of the double bottoms to your advantage, right? So go through the double bottoms, identify the two areas, two bottoms, then the peak, do the projections. I showed you how the projections are done. This needs practice. This is one of the simplest or one of the simple chart patterns, but very useful, right? Make use of it, and you might be able to be rewarded out of it. So with that, okay, one last chart, as one of our friends requested, valuable one. Valuable one, you can't, okay, you can see that there is a valley here, right? You can see that there is a valley over here, and moving up to this level. Then you have this. So basically this area, 63 rupees. 63 rupees is the peak. So the 63 rupees has to be tested, or rather retested, and move up. If that takes place, you can see that it can go up to meet that projection, right? So this is how it's done. The more you draw this, the more you practice it, thereafter what you can do is you know, now these are current areas. The breakouts are yet to take place, right? So you can watch these, you know, you can draw your own chart and watch whether it will work, right? So end of the day, for it to work, it's around 73. Yeah, it's something like 73.20. Yeah, 73.20 is the area that it can go up to. Once that 63 is broken with volume, right? Here you can see that when the prices went up, you can see that the volumes increase. Now the prices are coming down, the volumes are coming down. The next time around, the volumes are going to increase, particularly at 63 rupees. If the volumes are going to increase, then you can expect this area to be tested. So until the volume behavior, the breakout, the retest takes place, you don't move in to a trade. That's how we do. We make use of the pattern called the double bottom. And once again, let me call it a day today, for the day rather. And if you have any further questions, just I mean, we will open it up for you, or otherwise we can call it a day. And if you have any questions, you're free to, you know, contact us, and you know, we are there to help you all to, you know, increase your knowledge.